You can't escape the headlines. Prices are surging around the world thanks to a perfect storm of factors: pandemic-induced supply chain bottlenecks and the war in Ukraine. The latest lockdowns in China are also expected to add to supply snags.
So such a swing, especially in the US monetary policy direction, from previously quite extreme dovishness to now extreme hawkishness, has been really unprecedented.
Increasingly, there's a sense that inflation, not too long ago seen as transitory, is here to stay.
So I think the language really has shifted, because I think a lot of the assumptions, that the supply chain issues were going to go away once the pandemic subsides, it doesn't appear to be the case. I think if anything, the start of the Ukraine war has actually flagged, some of the problems that we're having with energy prices, with food inflation.
While inflation is a sign of a healthy economy, too much inflation is a red flag.
The reason being that, if your wages doesn't increase every year, then that's not really a good thing. So some inflation is good. And, major economists, they normally target around 2% increase a year or over the medium term. So that is a good number to aim at.
With Singapore projecting core inflation for 2022 to come in between 2.5 and 3.5%, the Monetary Authority of Singapore is leading the charge in Asia to dampen the impact. It has tightened monetary policy for the third time in 6 months. Meanwhile, South Korea has unexpectedly raised interest rates.
We are basically in a global tide where all the central banks around the world, except with maybe the exception of Chinese BOC, where they are actually still reducing interest rates. So we are kind of like keeping pace with the global tide of monetary tightening. So I suspect that it will buy us a little bit of relief, but not that much.
In such uncertain times, how do you inflation-proof your portfolio? One place to look is the bond market.
So there are a couple of ways you can do this. I think for bonds, for instance, some would advocate that you actually shorten your duration. So when interest rates rise, in terms of the impact to your bonds will be less severe than otherwise would be the case. The other option, of course, is to switch from fixed to floating rate bond instruments. So as interest rates rise, then in terms of your bond yields, they will also rise in tandem.
One consider, the real estate market is still good, it's still firm. And obviously, in the case of Singapore, authorities are always constantly looking out for whether you have speculative activities that take place. Global real estate and property prices has risen because of low interest rate and plenty of liquidity.
While equities remain volatile, experts say businesses that can pass on price hikes to consumers are a good place to invest.
This reporting season is particularly interesting and important to hear from all these consumer companies to what extent they pass on or have been able to pass on the higher costs. Those that sort of benefit from higher lending rates, certainly banks, example as well, have done well just from the fact that they have been, say, in the trading side, lots of market volatility, volume. So that's one advantage.
Gold is also traditionally seen as a safe bet, though it might lose its shine as the geopolitical situation stabilizes.
So if we see geopolitical tensions actually start to subside, or if the Fed, for instance, starts to be a little bit less hawkish, and they start to try to focus more on trying to engineer a soft landing. So in that kind of circumstances, then we actually may see the appeal of gold actually retracing.
And even though interest rates are rising, it may be wiser not to keep excess cash on hand.
But if the bulk of your assets are in cash, then actually, the reality is that the savings rate interest is still very, very low. So you are actually, suffering from the opportunity, that would have been forgone otherwise. I think as far as cash-like instruments, for instance, so it may not be sitting in pure cash, but you could redeploy them into some short maturity type of like treasury bonds or treasury bills, for instance, government bills. So those have seen quite a fair bit of interest. In fact, if you look at the recent 6 and 12-month Sing dollar treasury bills auctions, they have fetched a fairly attractive interest rates of above 1%.
Experts predict inflation has not peaked, so buckle up for the ride. The volatility is expected to persist at least in the near term, with more tightening measures still expected.
I think the mindset and the story has shifted quite a fair bit away from the pandemic to really focus on the inflation story and the need to basically tighten or at least recalibrate and normalize some of the very accommodative policy stance that we've seen over the last 2 years. So it's kind of like that baby step shifting back to pre-COVID norms.